Imagine you are Warren Buffett, sitting in your office, sipping a Coke, scanning balance sheets, and finding hidden gems in the market that everyone else overlooks. That's value investing, the art of buying something for less than it's truly worth. For decades, it has been one of the most reliable, proven ways to build wealth. But here's the big question. Does value investing still work in the age of artificial intelligence? Because now, the market is no longer just driven by humans reading annual reports or watching CNBC. It's dominated by algorithms, machine learning systems that analyze billions of data points in milliseconds. AI can read earnings reports, scan sentiment on Twitter, analyze trends on Reddit, and execute trades faster than any human ever could. So how can an investor who believes in long-term value compete in this world? Or better yet, can value investing actually thrive because of artificial intelligence? Let's find out. First, let's remind ourselves what value investing really is. At its core, it's incredibly simple. Buy good companies at a discount and hold them long enough for the market to recognize their true worth. It's the idea that price and value aren't the same thing. Price is what you pay. Value is what you get. Warren Buffett, Benjamin Graham, and Charlie Munger built fortunes on this philosophy. They looked for companies with strong fundamentals, steady earnings, low debt, loyal customers, and great management, but temporarily undervalued by the market. They ignored hype, fear, and short-term trends. They trusted math and patience, but the world in 2025 doesn't move slowly anymore. We live in an era of speed. Data floods the market every second, and AI algorithms react instantly. So, is the patient, methodical style of value investing still relevant when machines are trading thousands of times per second? Here's the surprising truth. Yes, and maybe now more than ever. Because AI has changed how value is found, not whether value exists. Think about it. In every market shift, new tools emerge, but human behavior stays the same. People still get greedy. People still panic. Markets still overreact. And that's where value investors thrive. In fact, AI may actually be creating more opportunities for value investors by amplifying short-term volatility. When algorithms chase trends or react emotionally to headlines, prices can swing wildly, detaching from real fundamentals. That's when the true investor, the one who understands a company's long-term worth, can quietly step in and buy. Let's break it down further. AI and market efficiency, the myth and the truth. Many people think AI will make markets perfectly efficient, that every stock will be perfectly priced all the time. But that's a myth. AI makes the market faster, not smarter. Sure, AI can process more data than any human ever could, but it doesn't understand context or human emotion the way you do. It can't always tell when a company's culture is strong, when a CEO is visionary, or when a new product could redefine an industry. Machines can measure numbers, but they can't measure trust, reputation, or brand loyalty the same way humans can. So while AI might dominate short-term trading, long-term investing, the kind that looks beyond the noise, remains deeply human. 2. AI as a tool, not an enemy. The smartest investors today aren't fighting AI, they're using it. They're using machine learning tools to screen thousands of companies faster than ever before. AI can quickly identify financial ratios, detect accounting red flags, and even predict which companies might outperform based on historical patterns. Imagine combining Buffett's patience with AI's analytical power. That's the future of investing, augmented intelligence, not artificial intelligence. You could use AI to scan every company in the S&P 500 for undervalued price-to-earnings ratios in seconds. Detect sentiment changes from investor reports or social media chatter. Identify industries that are trending up before mainstream media catches on. But the decision, the judgment call, still comes from you. Because investing isn't just math. It's psychology, timing, and vision. 3. How AI has changed value. Here's another twist. The definition of value itself is evolving. Traditional value investing focused on things like low price-to-earnings ratios, steady cash flow, and tangible assets. But in the age of AI, intangible value matters more than ever. Data is the new oil. Algorithms are the new factories. And intellectual property, not machinery, drives modern profits. So, while a traditional value investor might overlook companies like Nvidia, Google, or OpenAI because they seem overvalued on paper. In reality, their true value lies in the technology moat. They've built something that doesn't always show up in the financial statements. This means modern value investors must learn to measure intangible assets, things like data, innovation speed, network effects, and brand power. In other words, the principles of value investing haven't changed, but what defines value has. 4i-driven volatility, a hidden gift. Ever notice how the market now reacts instantly to news? A single headline can cause billions to move in seconds. That's AI at work, algorithmic trading reacting to keywords and signals. But those reactions often go too far. Stocks get dumped over a temporary fear or hyped over a minor success. And when that happens, prices move away from fundamentals, exactly where value investors find their edge. So ironically, AI might be the reason value investing becomes more profitable, because volatility creates inefficiency, and inefficiency creates opportunity. When everyone is chasing momentum, the calm investor who buys great companies during panic will always come out ahead. 5. The emotional advantage, still human. No matter how advanced AI becomes, it doesn't feel emotions. It doesn't panic. It doesn't get greedy. But it also doesn't see opportunity when the crowd is scared. That's where humans still win. AI can't sit calmly through a 40% market drop and say, this company is still strong. It can't recognize when fear is irrational. It can't take the leap of faith that great investors do when everyone else gives up. Discipline, conviction, and patience. Those are things no algorithm can replicate. So even in 2025, the greatest edge you have in the market isn't faster data or bigger servers. It is emotional control. 6. Blending old wisdom with new tools. The best investors of this decade won't be the ones who reject AI or the ones who rely on it completely. They will be the ones who blend both worlds. Use AI for what it's good at: data analysis, pattern recognition, and screening opportunities. Use human judgment for what it is best at: understanding stories, leadership, innovation, and human behavior. That's how you create a modern-day version of Buffett's strategy, one that's powered by AI, but guided by timeless principles. Imagine using AI to find undervalued companies faster, then applying classic value metrics to confirm the fundamentals. That's not replacing human investors, that's supercharging them. 7. The future of value investing in an AI world. So what does the future hold? Will AI eventually dominate investing completely? Maybe not. Because the market isn't just numbers, it's people. It is driven by emotion, fear, hope, and narrative. And as long as those exist, there will always be mispriced assets. There will always be hidden value waiting for someone patient enough to find it. AI might know everything, but it doesn't understand everything. It doesn't dream, it doesn't believe, and it doesn't invest for legacy. You do. So don't think of AI as the end of value investing. Think of it as its evolution. The investors who embrace both data and discipline, both automation and analysis, will be the ones who build real wealth. Because while machines are busy trading noise, humans can still invest in signal. While algorithms chase speed, humans can still build conviction. And while AI focuses on what's trending, the best investors will focus on what's lasting. So yes, value investing still works. But the value investor of the future must evolve, become smarter, faster, and more open-minded. Because in a world run by algorithms, the greatest edge isn't technology. It's perspective. If you found this video valuable, don't forget to hit like, subscribe, and turn on notifications, because the age of AI is just beginning, and smart investors will be the ones who learn to master both the machine and the market. Stay curious, stay patient, and remember, in any era, value always wins in the end.